Okay, so good evening, good morning, whenever you're watching this. Welcome to the second webinar I'm doing. This time it's on divergence, and that's something people have been seeing a lot of recently. And I know Rich has been mentioning it a lot, and a lot of people have been saying, what is that? Well, I thought I'd go into what divergence is and how you can use it to trade on your own and just to spot a really good potential signal, whether it's Forex or binary, as it can just confirm confidence in something. So you may be confident enough to double up on something. You may not be, but this is very important in trading. So what is divergence? Oh, my animations didn't work. Damn. Oh well, who cares? So divergence is it's a difference between what traders are doing and the value of an asset. So I was going to go through these one at a time, but whatever. Okay. So essentially, when you're trying to find divergence, you have an indicator called an oscillator showing underneath your graph, and I'll show you an example of this in a minute. And this shows what actual traders in the world are doing. So it shows whether they're buying more, whether they're selling more. And obviously, you've got a chart above it of an asset. Let's say it's euros versus US dollars. We could perhaps see the currency chart going up, and it's climbed by however much, 20 pips, let's say, in 10 minutes. Wow, it's incredible. But on this oscillator, it's going down, meaning these traders are actually selling. So why is it going up? It's an anomaly in the market, and that's sort of feeding into this, that some people don't understand why it happens, but in the world there's loads of traders all over the place, and they're all doing what they're doing for their own good. And there's also these huge financial institutions, which I've mentioned before in the last webinar, and they are the driving force of the market. And sometimes we won't always know what they're doing. Sometimes one doesn't want to declare what it's doing, so it won't appear on an oscillator. So it will just prop up a currency, let's say, and then drive it up, whereas all the other traders are selling it. But as we know, these groups, these investment banks are so huge that all the traders banding together in the world can't stop them. So when they're buying, it drives the whole market up by the sheer quantity they're buying. And I've pretty much said the third thing about twice now. I won't bother repeating it. So there's two types. This one's going to work. There's two types of divergence. There's regular and there's also hidden. Now, regular divergence, that's something you can look at, and it's, obviously there. Same for hidden, but I actually don't know why they're called regular and hidden. But I won't go into that because I have no clue. So regular divergence, what is it? This signifies a possible trend reversal. So when you have regular divergence, you've got higher highs on the chart of a currency, and that isn't matched by what you see. You see something like this. So here we have what's meant to be a chart of an asset. Let's say it's gold, and this is an oscillator. Normally I use RSI, and I'll go into what I do towards the end of this once I've gone over this, so it'll make a bit more sense. Otherwise, it's just useless information. So on the value of gold, let's say this is a day, this period's a day. In the day, the actual asset's gone up and it's fallen back down. It's now gone to a lower low. However, according to my oscillator, gold should have climbed because more people have actually been buying it. There's a higher low. That can't be possible. How can an asset go down in value when more people are buying it? Banks. So regular bullish divergence. So regular bullish divergence is, sorry, bear with me, something's opening itself. Let's close that. Okay, sorry. So regular bullish divergence, this is when the price is falling. So the asset, gold, let's say, has gone down in value in the period of a day. So the low is lower. However, the oscillator, my indicator at the bottom beneath the graph, is climbing. It now has a higher low. If that's the case, there's a difference. And this shows that an asset is going to switch direction. And in this case, it means the asset is going to go up in value. So the bears in the market are running out of energy, meaning they're done selling. They've reached their point. They don't want to sell anymore. And the bulls are now buying more. This could, emphasis on the word could, cause a trend in the opposite direction, because this isn't guaranteed. Things don't always follow the rules. When big banks can simply say, actually, do you know what? No, I'm going to stop doing this. They'll stop doing whatever they're doing and it will switch. Or they could say, I'm going to carry on selling all of my gold, meaning the value is going to go down. And this, when the longer this goes on for, the longer the divergence is actually appearing in the market. Sorry, bear with me. So the longer this is in the market, the bigger the repercussions. So that means if this has been going on for 3 weeks now, at some point there is going to be a huge, huge breakout. And I mean, if you were to, this would be like not Brexit level, but it'll be as closest thing you'd see to Brexit for a long, long time. It would be insane. It would be a massive, massive jump of a currency. So I've got a little chart, and this is this is stolen from Baby Pips. I'll admit that, but the reason was I've stolen all of these from Baby Pips because they're perfect examples, and I don't want to try and find ones which aren't as easy to see. I wanted to use this one though because I thought this is hard to see, but I thought this really shows how hard it can be to spot. This low is on the this low on my oscillator down here is so minute. It is so minute you can't really notice it's gone up, but it has. Whereas this has obviously gone down. This is USD JPY dollar versus Japanese yen, and it's fallen down. However, on my oscillator, I can see it should have gone up a little bit. So because this is so different, it's not really going to cause that much of a breakout, but it does start causing a gentle uptrend for a short period of time here. And then it just drops back down, but then it starts going back up again. So it does spring back up. It's sort of a lot. I can't say all of the time, but a lot of the time it will just gradually go up. Something, because I mean, what period is this? Okay. Well, over this period of time, we've got an increase. It's not huge, but over the time it goes up quite high. It goes up really, really rapidly. If you think about it more long term. So forex traders, this is like where you want to hit your trade. When you spot it, hit a trade, you'd probably hit the trade somewhere around here, but that is a lot of pips there. So that's a lot of profit. Binary traders, you'd want to stick a longer trade on it and just be patient. You don't want to go for a quick trade. Yeah, you could win a quick X period trade, but the odds are that it's going to bounce back pretty quickly because after 2 candles here, it comes back down. It does spring back up, but there is the possibility that you caught it and your trade closes here at this low where you have lost because you placed the call somewhere around here. Forex traders, this longer term stuff is easy for you. Binary traders, I'd go for end of day things. Sorry, 2 seconds. Okay, according to this, it's still working, so I'll continue. But I've had someone say they can't hear me. But also, one thing I'd like to point out is that this generally matches. I mean, there'll be little idiosyncrasies along the chart where the drop is perhaps a bit bigger than you'd see up here. I mean, this corresponds to up here, and the drop is bigger here than it is there. But as we can see, the asset did fall here. That's what's caused that. Oh, this is why it happened. But then the bulls took over and it rose again. And as it comes back down here, it's coming down here. That's why divergence is a thing, because this should always correspond to this. And when it doesn't, something's wrong. There's a trade to be had. Okay, sorry you lost me, but okay, let's carry on. Bearish. So this is when the price of an asset is climbing. So the highs are getting higher. The oscillator is climbing as well, but oh no, sorry, it's falling. I was meant to change that. Sorry, no, I was thinking that sounds a bit wrong. No, the oscillator is falling. I should say the oscillator is falling. The high has got lower. And it basically just shows the complete opposite of what I said before. The bulls are running out of energy this time, and the bears could soon cause a reversal in trend. So an uptrend becomes a downtrend. this is my example, and this one is perhaps a bit better, but I think it does sort of help me prove my point that I gave last time, that it doesn't always kick in instantly. Once you hit the higher high, you've got a higher high and a lower high, and this again is so marginal, but it is there. The lower high is there, but maybe it's minimal, but the difference is there. I mean, these tiny little things can lead to longer term trades. I mean, this is a few days, this chart. So if you were a Forex trader and you're patient enough, that is an awful lot of pips. That's what I'm actually working it out. Wow. I'm not going to say that number. You can work it out yourselves, but Forex traders, that's a lot of profit if you're patient enough. I mean, most people probably cash out somewhere around here. They never take profit nowhere near there actually, but binary traders, if you hit your, this is actually this is a big breakout. This is a very big breakout for Divergence, but it's a longer one. The point is that with Divergence, things aren't going to be instant. They're going to take their time, and it'll be a bit like removing a rock at the bottom of a pile of rocks. The one rock will tumble from above, and eventually the rest will all come down all at once. So at first, it's one rock falls, but the rest stay fine for a minute, and then boom, massive drop off. And I mean, this is a perfect little downtrend in the channel there. But there was a breakout there, but then it falls back in. So the idea is that it's hard to grasp Divergence. I mean, I'm finding it a little bit hard to talk about, but this does take a lot of work. I mean, Divergence isn't something like a support and resistance where you just draw your lines and you get it. You need to practice using it. I mean, if you do want to start trading with Divergence, it's probably, in my opinion, the best tool to have in your trader toolkit. But you need to work on it. This isn't something I go straight into with real cash. Demo it first, by all means. But the time frame with which these things can take hold. I mean, this took a few days to fall, whereas before it was a matter of hours, and there's a big drop off. So it's hard. I'm going into hidden divergence now. This is slightly different. This sort of confirms that it sort of confirmed the trend more than reversing it. So with regular divergence, and I go back again, the lower high here against the higher high means the trend is going to change direction. So this uptrend is now becoming a downtrend. However, with hidden divergence, you've got a higher low or a lower low. This is the example I've got here. Higher low and a lower low. Higher low on the asset, lower low on your oscillator. This just confirms the trend is going to continue going up. It can also use the word boost. That isn't a word that is commonly used, but I thought it sort of gives, I think it's the best possible word to use to describe this. An asset can just shoot up for a period of time and then just fall back to the norm and carry on doing what it does normally. But I think the term boost is a great one because it just shoots up and then it'll just go back to normal. So it accelerates and then just carries on at normal speed. So hidden bullish divergence. So this is when the price is rising. The lows are getting higher. There are higher lows. However, on the oscillator, the oscillator is falling. So the lows are just getting lower and lower. Now, this shows there's an underlying strength to an asset, and there's the potential it could rise. I'm always using these conditional words, could, because it isn't guaranteed. These things aren't guaranteed. There will be times when it just doesn't happen. Like I said, a bank could carry on doing what it's doing. And when it does do that, it could influence a lot of traders to trade with it instead of trading against it. So whereas the traders are trading, they're all buying, the bank is selling. They realize after a while the bank is just going to keep selling and they can't trade against it. So they'll just trade with it instead. That can happen. So the breakouts might not always happen. The oscillator might just correct itself instead of there being a massive breakout in one way or the other. So this is easier to see. This is a very long chart. This is daily charts. Each candle is 1 day. So we've got on the chart, we've got lows getting higher, and the oscillator, the lows are getting lower. So overall, the asset is climbing. It should just go on a nice uptrend forever in a perfect world, but it doesn't. Um, but the oscillator says that it should have gone down. When this happens, this is like a really good entry point or re-entry point if you've already got a trade going. This is when an asset will go on this. For this example, the bullish hidden divergence, the asset is going to climb in value. When the asset goes up, we can see this starts to match again. And I want to see if there's any other points of divergence on the chart. But I can't see any because I was trying to feed something in, but this world isn't perfect. I'll come on to that in another divergence webinar because that was going to be a whole other level, but we'll keep it more simple for now. So the lows are getting higher and the lows are getting lower. This causes the asset to climb. Now, this is a nice big jump on a daily trade. If you traded that, if you picked up in the morning, closed at the end of the day, that's a nice amount. However, if you wanted to wait a long period of time, you can get a lot for forex traders, a lot more pips. Binary traders, that's just the perfect day trade. You can open in the morning, you spot the divergence, go with the call, and there you go, nice trade. I want to go back a bit again. With this, I want to emphasize the could because I think I should get more charts for this next time so that I can show you that it doesn't always happen. I mean, in this scenario, it climbs, and arguably a lot of traders would think that's the end of it there and they'd carry on trading down. But no, it carries on again. It restarts itself. And I think what I'd like to say is with divergence, it can change really quickly. I mean, when you're watching an asset climb in that, when you're watching an asset climb and fall, you may just spot trends and channels, but it really helps just to have an indicator open like at the bottom. Personally, I use moving averages a lot and RSI as well, which is what I use to find divergence. Hidden divergence, in my opinion, leads to there's no fact in this. I'd like to say opinion, but I feel like it's the wrong word to use. In my opinion, will lead to bigger breakouts. I mean, on a day trade, that's a big jump. Binary traders, you'd probably be able to get 3 trades on that because it just keeps going up. You could put 3, 4 on, and by the end of it, you're 4 trades in profit because it just keeps climbing. I'm going to bearish divergence. I'm just going to keep going on and on and on. This is when the price is falling. The highs are getting lower and lower, and the oscillator is climbing. And that means the highs are getting higher. This means there's a weakness to an asset, and at some point, the asset's value could fall. Now, I've got a slightly trickier one to see again. The high gets a little bit lower, not that noticeable. However, the high on here gets a little bit higher. There's a massive breakout causing a really abrupt, it's just a breakout. I can't call that a trend. There's a breakout in a bearish direction. And then the gradual uptrend, little breakout, uptrend carries on. This is audio USD, and I mean, you should look at that currency because this sort of pattern appears a lot. And that's a big thing with technical analysis, just spotting patterns and knowing when they're going to repeat themselves. So divergence essentially is when, as I've said now, there's a difference between what traders do and what's going on. In this case, it's really hard to spot, but it is here. So the problem with trading divergence is that you need a really, really, really fine eye. You need to be able to spot these tiny differences, and drawing support and resistance lines really, really helps with this. Because I mean, if you drew a resistance line here, just going along this, you could realize there's a lower high here. And then you could also perhaps look at your indicator and say, hey, wait, there's a higher high here. I would say to you all, when you're trading, even if it's signal, just open RSI. And I personally have it set to the number 4. Just I won't go into that, but just set it to 4. When my RSI set to 4, I'll just observe what the asset's doing down here whilst I'm trading. Now, when you're trading signals, this can be literally how the trader finds their trades. When you see, if you can ever spot any of these, just draw the lines, because the more you practice, the better you'll get. And I mean, as you've seen from all the examples now, there's one example where it's really clearly divergence, and the other 3 examples, it's not always noticeable, whether it's on the chart, not noticeable, or on the oscillator, not so noticeable. On here, it is more noticeable than some, but it can be hard to spot. So practice drawing lines on your oscillator and on your chart, so you can see where your resistances or supports are for trading all of these. I'm going to actually go back a bit to this one, because this one is really obvious. So you've got a support line drawn here, and yeah, these can be extended forever and ever, and you can trade a breakout later on at any point. I mean, you can extend this, and that would then be confirmed here again as support line. But when you've got this indicator open, even if you don't see it at the time, perhaps when you're about to stop trading, just look back and you'll notice with this support line, when there was a breakout, when it was broken here, the asset broke out down here. There's your support and resistance being used to create trades. But when you look back at your trade today, you can have this indicator open. As you scroll backwards through time, you can have this and it will scroll back with you, corresponding exactly to where you've done your trade. So at this point, you've placed the call and you've won. But you've also then noticed that divergence was in play down here. And you realize that it wasn't necessarily, that wasn't necessarily a reason for the trade to happen. I mean, the support wasn't necessarily a reason for a trade to happen. The real reason this trade here happened was because there was divergence. Divergence sort of acts as like the root cause for a lot of trades. I mean, I seriously say, just spend one day in your trading, or maybe look at the weekend back at charts from the week. Just look at the charts and just see how much divergence you can find. Just practice seeing it, but you'll also notice how much it affects the market. I mean, it may be minimal, but it is there. See, I'm going to say now, look, there's this low here, and there's this low here. I can't tell exactly because I can't draw on this chart, but I would bet this is a little bit higher. This is what I mean by a fine eye. Like, I mean, it may be literally a few micro pips, but it would still be there. Here is a low. Here's the next low. So you've got a lower low on your oscillator, and you've got a higher low on your chart. That's divergence. The reason when this asset hit here, when it bounced back, divergence. It wasn't. That's the reason this support is here. Divergence is the reason in a way. It's a bit hard to get your head around maybe, but that's the reason. Divergence is the root cause for this trade here and this trade here. I'm not going to keep going and finding more and more, but you get the point. Support and resistance are a thing, not because of divergence, but divergence helps them exist, if you understand that. That's the end of the PowerPoint. I was wondering if any of you have any questions. I know there's some of you watching live. Some of you want to watch it later. That's fine. Feel free to ask me any questions. You don't have to get in touch with me. Does anyone have any questions? Because this can be a tricky topic, and I mean, some people will spend months and they still won't get this. Some people get it like that. So if anyone has any questions, ask them now in the chat window, because I'll share them with people who are going to watch this later, and I'll answer them now for you as well. So perhaps questions don't get repeated as much. A bit nicer for me. And I'm also going to go back to the regular divergence, as I just want to see if there's any other points that don't match. Because to be honest, on these charts, there's bound to be more than just regular divergence. There's probably hidden divergence somewhere on here, but they don't want to show that. They're focusing on the one thing. I'm just having a little look. I'm looking for the less obvious ones as well. Okay, I just got one question. if we want to trade it short term instead of 4 hours chart and daily charts, what time frame would I recommend? Okay, I'd recommend looking at all different time frames. With binary traders, with trading personally, whenever I'm trading, if I've got an asset open and let's say I want to do a 30-minute trade, this is a binary scenario. For just so you know, if I want to do a 30-minute trade on an asset, I decide, you know what, I'm going to do a 30-minute trade. Not sure how I'm feeling. I would never open just the one chart. I would never open just like a 5-minute candle chart. I will open another chart as well. I'll open a 10-minute or 15-minute candle chart as well as a 2-minute chart. That way I can see lots of different, I can see all of it and see where there's little mistakes in a way. So when there's a 2-minute for example, there's a downtrend like this, but there's a little candle here like this, that can show me there's a little bit of divergence there, and then it could perhaps indicate that this candle here could cause divergence. I mean, in this scenario, it isn't happening down. You can see that, but the point is it can happen. So I have 3 charts open. If you do want to trade it short term, personally, I recommend going for 5-minute time frames, 15-minute and 30-minute. I mean, never go for 1-minute trades of divergence. I mean, it is doable, but I mean, I am now still trying to just get my head around 1-minute divergence because often I will lose by 1 second. My trade will be out and then it closes 5 seconds later. It's well in. It's gone really far in. So 2-3-minute trades, they're doable. That's the shortest time frame I could say to do, but I wouldn't recommend that. I'd recommend perhaps starting at 15, 10-minute trades, depending on the platform you're using. I recommend with just you trying to go for the 15-minute-ish trades, plus or minus 5 minutes. That's probably the best. And with the charts that I'd go with a 15-minute chart with a 30-minute chart and a 5-minute chart as well, and have them all alongside each other, all with their own RSI on it. Or there's different indicators you can use this, but RSI is my favorite oscillator. With your oscillator on as well on each one, because you can spot divergence on each one and how it's affected the asset in tiny ways. And with technical analysis, a lot of it is just patterns repeating themselves. I mean, they won't look exactly the same, but there are similarities. I mean, here I'm going to go with just this bit here. This sort of just curves up then down. This sort of curves up then down. It's not exactly the same, but the same. I mean, this may sound stupid, but certain assets. I'm actually going to go for the AUD USD chart. I can't remember where it is, but I think that's the perfect one. Was that my last one? Yeah. With this, I mean, it's literally just up. Sometimes it's really obvious, like up 2 candles, down 1 candle, up 2 candles, down 1 candle. So patterns repeat themselves. I mean, you need to learn with trading. The patterns keep repeating themselves. So when you've got 3 charts open, you can spot patterns in one time frame and divergence in that time frame, which then, for whatever reason, may not exactly match up with divergence on another with your oscillator on another time frame. Meaning you can start to see potential divergence from looking at one chart with divergence. 5 minutes chart to trade, 15 to 30-minute expiry, right? If I wanted to do a 15-minute trade, I'd have 5-minute chart, a 2-minute chart, and a 15-minute chart all at the same time. I mean, the 15-minute chart doesn't really fit well. If you can get access to a 10-minute chart of the asset on the same platform, don't go to another platform for that. I mean, unless you're using TradingView, then that's fine. But on a trading platform, if you're doing it all on there, stick to that. If you're using TradingView, try to keep it all on TradingView. So I mean, the charts will match up then. So if I was to trade 15, 30-minute expiry, 5-minute chart, 5-minute, 2-minute, and ideally a 10-minute chart as well, that'd be perfect. Or 2 minutes, 3 minute, whatever. But ideally not 1 minute, more than 1 minute, but less than 5 minutes, and 10 to 15-minute chart as well. I think I'm going to call it an evening there. If you have any questions, feel free to email me or give me a message on WhatsApp. I'll go back to the first slide. There's my number. So I'm pretty sure I've got everyone now, but just drop me a message or drop me an email. And probably by, let's say, Saturday, I'll put them all up in a PDF and send them out to everyone so everyone can see the answers again. I hope you've learned something, and this can be tricky, but I'll be sure to link you a little cheat sheet for Divergence, and just practice. Keep practicing drawing support and resistance lines, as they're really key for this, as well as spotting the differences. And good luck with your trading. I hope you enjoyed this, and thank you very much for coming and/or watching. Have a nice morning, evening, or afternoon, wherever you are in the world. Thanks.